Do you want to buy a home in the Denver area, but you're not sure how much you can afford and you'd like to see how to qualify? Well then, watch this video. What we're going to discover is what you can afford and how to qualify. And if you like what you see and you decide you'd like more help and information on buying, then go to nickbrownhomes.com. Let's jump into the training. There are three pillars of lending. We're going to talk about and concentrate on one of them today, but the three of them are your income versus your debt, your credit, and your down payment. Today, we're going to concentrate on your income versus your debt, as this is the major piece and major hurdle, and it does not change based on what loan type you go with. So, what are the rules when we're talking about income versus debt? The first thing you should know is that a bank is looking for steady employment. That's because they really only care about if you can make your payments. This loan's going to last for potentially 30 years, so they want to make sure that you have at least 2 years of steady employment as proof of the ability to pay. Now, if you're a salaried employee, you're good to go. That's really straightforward. If you make a certain amount, they just divide it by 12, and that is your gross or before tax monthly income. But if you're not salaried, then the first step is to calculate your actual monthly income. What we're going to do in most of these cases is do a 2-year look back and an average of the money you made over the last 2 years. These non-salaried types of income can include things like commission income, bonus income, self-employed income, part-time work, second jobs, rental income, and a bunch of other types that are probably out of the scope of this video. Once we have factored your gross monthly income or before tax monthly income, same thing, now it actually gets really easy. This is the fun part. So what do? It's really quite simple. We take your gross monthly income and we chop it in half. And if you have no other debts, then that is the maximum house payment that you can afford. So let's look at an example. Let's say you make $48,000 a year, and that divided by 12 is $4,000 per month before taxes. So if you have no other debts, we chop that $4,000 in half, and your maximum house payment you can afford is $2,000. Pretty easy. Okay, but Nick, I have some debts. I have a car payment, I have some student loans, and I have some credit cards. So now what? Okay, well, let's look at that example and see how that might look. Let's say that your car payment is $200, that you have minimum payments on your credit cards of $100, and that your student loans is another $200, and all of those combine to $500 a month. Great. Well, you make $2,000, and we have to subtract out the $500 from that, and that is your new maximum house payment you could afford. $1,500. That's it. That's how we do it. Now, the next step is we're going to use that payment of either $2,000 or $1,500, whichever applies to you, and we're going to back into one of the three main loan types that we're going to talk about in the next video, depending on your credit score and your down payment. And those will be covered in the next video on the three main loan types. If you thought this was helpful and you'd like me to do this for you, just head on over to nickbrownhomes.com and you'll see a little form at the bottom on how we can get in touch with you, and we'll see if we can help. Now, thank you so much for watching this video, and I look forward to helping you take the mystery out of the buying process.